Something unusual has been happening in the global financial system, and most people haven't noticed it yet. There are no explosions, no breaking news sirens, no dramatic speeches, yet the consequences could shape the next decade of the world economy. For years, investors believed one thing was permanent: the United States could always borrow cheaply. That assumption was the foundation of modern finance. Mortgage rates, stock valuations, venture capital, startup funding, even government stimulus programs, all of it depended on the idea that money would remain relatively inexpensive. But foundations don't crack overnight. They shift slowly, almost silently, until one day the structure above them begins to tilt. Right now, that shift is underway. To understand why, you have to look at the bond market, not the stock market, not crypto, not real estate. The bond market is where the real signals appear first. It's where governments finance themselves, where banks park their reserves, and where global power quietly moves. And one of the largest players in that system has been changing its behavior. For decades, China accumulated enormous reserves of U.S. treasuries. The arrangement was straightforward. China exported goods, earned dollars, and reinvested a portion of those dollars into U.S. government debt. That cycle supported low borrowing costs in America and helped stabilize China's own currency. It was not charity. It was mutual benefit. American consumers gained access to inexpensive goods. China gained stable demand for exports and a safe place to store foreign reserves. Economists often described it as a feedback loop that reinforced globalization itself, but feedback loops can reverse. Over the past several years, data has shown a gradual reduction in China's treasury holdings. Not a sudden liquidation, not a dramatic collapse, just a steady, persistent decline. On its own, that might not seem alarming. Large holders adjust portfolios all the time. What makes this different is the broader context. At the same time those holdings have declined, geopolitical tensions have increased, trade relationships have changed, and global supply chains have been reshaped. The world is moving from an era of integration to an era of strategic competition. And when competition replaces cooperation, financial flows start to follow political realities. Think of the global financial system like a massive reservoir connected by thousands of pipes. When one of the largest valves begins to close, pressure builds elsewhere. Interest rates begin to respond, currencies adjust, and investors start asking uncomfortable questions. One of those questions is simple: who replaces the buyer that steps back? Governments around the world are issuing more debt than ever before. Budget deficits have expanded, infrastructure spending has surged, and military expenditures have risen in multiple regions simultaneously. All of that borrowing requires buyers. When demand weakens, yields rise. That is not ideology, it is mathematics. And yields do not rise in isolation. They ripple outward through every part of the economy. Corporate loans become more expensive. Car payments increase. Credit card interest climbs. Mortgage rates adjust. The average person may never read a Treasury auction report, but they feel the effects when they refinance a loan or sign a lease. This is why the bond market matters so much. It operates behind the scenes, but its influence is everywhere. There is another factor many people overlook: diversification. Central banks do not hold reserves purely for profit. They hold them for stability and strategic flexibility. Over the past decade, several central banks, not just China's, have gradually increased their gold reserves and diversified into other currencies. This is not a sudden rebellion against the dollar. It is risk management. When a financial system becomes highly interconnected, participants begin to reduce single-point exposure. It's the same principle as an investor diversifying a portfolio. No one wants to depend entirely on one asset, one counterparty, or one geopolitical relationship. That shift, slow as it is, has long-term implications. It changes how capital flows across borders. It influences exchange rates. And most importantly, it alters expectations. Expectations drive markets more than headlines ever do. If investors begin to believe that borrowing costs will remain structurally higher than they were in the 2010s, asset prices adjust accordingly. Companies delay expansion plans. Housing markets cool. Governments face tougher budget constraints. None of this happens overnight. It unfolds gradually, then suddenly feels obvious in hindsight. There is a psychological dimension to this as well. For nearly 15 years after the global financial crisis, the dominant narrative was that central banks could always intervene, always stabilize markets, always provide liquidity. That belief created confidence. Confidence encouraged borrowing. Borrowing supported growth. But confidence is not permanent. It depends on credibility, and credibility depends on results. When inflation surged in the early 2020s, central banks were forced to raise rates aggressively. That alone changed perceptions. Investors realized that cheap money was not guaranteed forever. Now a new question is emerging. What happens in a world where borrowing remains expensive for years, not months? That question has no easy answer. Higher rates reward savers but strain borrowers. They strengthen currencies but pressure exporters. They stabilize inflation but slow growth. And in a global economy already navigating technological disruption, demographic change, and geopolitical competition, slower growth introduces its own risks. This is the environment in which the current shifts are occurring. It is not a single event. It is a convergence of trends, changing reserve strategies, rising borrowing costs, and a gradual rebalancing of economic power. Some analysts see this as a normal adjustment after an era of extraordinary monetary policy. Others see it as the beginning of a deeper structural transformation. What is certain is that the world of ultra-cheap capital that defined the 2010s is unlikely to return in the same form. That realization alone changes behavior. Investors become more selective. Governments become more cautious. Businesses focus more on cash flow than on expansion at any cost. And individuals, whether they realize it or not, begin to adapt as well. They postpone large purchases. They reconsider debt. They pay closer attention to interest rates than they ever did before. These small decisions, multiplied across millions of people, reshape the economy. The shift does not announce itself with a single headline. It unfolds quietly in Treasury auction results, in central bank balance sheets, in subtle changes in lending standards. Most people won't notice until the effects reach their daily lives, and by then, the transformation will already be well underway. In the next chapter, the real mechanics behind rising yields and why the bond market often predicts economic turning points long before the headlines start to come into focus. If you want to understand where an economy is headed, watch interest rates. Not the ones announced in press conferences, but the ones set in the open market every day. Long-term yields on government bonds. Those yields are not determined by speeches or political promises. They are determined by millions of decisions made by investors, banks, pension funds, and governments across the world. Every one of those participants asks the same question. If I lend money for 10 or 20 years, what compensation do I need for the risk I am taking? That single question drives the entire system. To see why, imagine lending money to a friend. If you trust them completely and expect repayment soon, you might charge nothing. But if you're lending for a long time and you're unsure about the future, you'll demand interest. The longer the time and the greater the uncertainty, the higher the interest rate you require. Now scale that simple logic up to trillions of dollars and entire governments. When investors buy long-term bonds, they are locking money away for years. They have to consider inflation, economic growth, political stability, and currency risk. If any of those risks increase, they demand higher yields. This is why the bond market is often called the most honest market in the world. Stocks can be driven by hype. Commodities can be influenced by temporary shortages. But bonds reflect something deeper, expectations about the future. And lately, those expectations have been shifting. One of the most important factors affecting yields is supply. Governments issue bonds to finance deficits. The larger the deficit, the more bonds must be sold. When supply increases faster than demand, prices fall and yields rise. It's basic economics, but the implications are enormous. For decades, strong global demand helped absorb that supply. Central banks accumulated reserves, pension funds needed safe assets, and international investors sought stability. The system functioned smoothly because buyers were plentiful. But demand is not static. It changes with economic conditions, demographics, and strategic priorities. As populations age in some countries, pension funds begin to draw down assets instead of accumulating them. As domestic investment opportunities expand, governments may choose to allocate capital at home rather than abroad. As geopolitical tensions rise, diversification becomes a priority. None of these trends make headlines on their own, but together they shift the balance between supply and demand, and when that balance shifts, yields respond. Rising yields have consequences that spread far beyond the bond market. Every financial asset is priced relative to interest rates. When rates rise, future earnings are discounted more heavily, which can pressure stock valuations. Real estate becomes less affordable because borrowing costs increase. Highly leveraged businesses find refinancing more expensive. It's like gravity increasing slightly across the entire financial universe. Everything becomes heavier. There is also a psychological component. For years, investors became accustomed to low rates. Cheap borrowing encouraged risk-taking. Startups could raise capital easily. Companies issued debt to buy back shares. Governments financed large programs without facing immediate market pressure. But when rates rise, behavior changes. Suddenly, cash flow matters again. Profitability matters again. Balance sheets matter again. This shift doesn't happen overnight. It unfolds gradually as each refinancing cycle forces companies and households to adjust. Consider housing. Mortgage rates are closely tied to long-term government bond yields. When yields rise, mortgage rates follow. That doesn't just affect new buyers. It influences construction, renovation, and the entire ecosystem around real estate. Housing is not just about homes. It's about furniture, appliances, materials, and employment across multiple industries. When housing slows, the effects ripple outward. Corporate borrowing works the same way. Companies that issued debt at very low rates years ago must eventually refinance. If rates are higher when that happens, interest expenses increase. Some firms can absorb that cost, others cannot. This is why economists pay so much attention to the maturity structure of debt. It tells them when refinancing pressures are likely to emerge. Another important element is liquidity, the ease with which assets can be bought and sold without moving prices dramatically. In highly liquid markets, large transactions can occur smoothly. In less liquid environments, even moderate selling can push prices sharply lower. Liquidity is often abundant during periods of easy monetary policy. Central banks expand balance sheets, banks have ample reserves, and investors are confident. But when policy tightens, liquidity can shrink. That doesn't mean markets stop functioning. It means they become more sensitive. Price movements become larger. Volatility increases, and volatility itself can become a signal. When yields move rapidly, investors begin to reassess assumptions. Risk models change, portfolio allocations shift. What seemed stable suddenly feels uncertain. This process feeds on itself. Rising yields can lead to portfolio losses, which lead to rebalancing, which can push yields higher still. It's not a collapse, it's a chain reaction of rational decisions made under changing conditions. There is another layer to this story: expectations about inflation. Inflation erodes the real value of future payments. If investors expect higher inflation, they demand higher yields to compensate. Inflation expectations are influenced by many factors: energy prices, wage growth, fiscal policy, and global supply chains. Even small changes in expectations can have large effects on long-term rates. In recent years, supply chain disruptions and geopolitical shifts have reminded investors that inflation is not permanently dormant. That realization alone has changed the baseline assumptions used in financial models. Markets are forward-looking. They don't wait for inflation to appear. They react to the possibility of it appearing. This forward-looking nature is what makes the bond market such a powerful indicator. It often signals turning points before they become visible in economic data. History offers many examples. Before recessions, yield curves have frequently inverted, short-term rates rising above long-term rates. Before inflation surges, long-term yields often begin climbing months in advance. These signals are not perfect predictors, but they provide clues about underlying pressures. Right now, one of the most important clues is persistence. Yields have remained elevated despite periods of slowing growth and market volatility. That persistence suggests structural forces at work, not just temporary fluctuations. Structural forces are harder to reverse. They are rooted in demographics, fiscal policy, and global capital flows, factors that evolve over years, not weeks. Understanding those forces is essential to understanding what may come next. Because the real story is not about one country buying or selling bonds. It is about a world in transition where economic relationships are being renegotiated and financial assumptions are being rewritten. And when assumptions change, markets reprice. In the next chapter, the focus shifts to the broader geopolitical landscape and how shifts in trade, energy, and currency systems are quietly reshaping the foundations of global finance. For most people, geopolitics feels distant. It's something that happens on television. Summits, sanctions, speeches, maps with arrows. It doesn't feel like it has anything to do with your rent, your groceries, or whether you can afford a house. But that's only true when the global system is stable. When the system starts to shift, geopolitics stops being background noise and starts showing up in the price of money itself. And the price of money is the interest rate. That's when the distance disappears. The last era of globalization trained everyone to think in one direction. Production would go where it was cheapest, goods would flow freely, and capital would move to wherever it earned the best return. Efficiency was the religion, stability was the assumption, but the world is changing, and the new religion is security. Security means redundancy. It means friend-shoring supply chains. It means stockpiling critical materials. It means paying more for the same product because the seller is politically aligned rather than simply cheaper. Security also means financial caution. It means not relying too heavily on a rival's currency or a rival's banking system. It means building alternative payment routes, alternative trade corridors, and alternative reserve strategies. This is where the bond market and geopolitics collide. When one country holds a large amount of another country's debt, that's not just an investment. It's exposure, it's dependence, it's leverage. And in a world that is becoming less cooperative, everyone starts reducing dependencies. That doesn't always look dramatic. Often it looks like normal portfolio management, a gradual shift from one asset to another, a slight change in reserve composition, a preference for shorter maturities rather than long-term holdings. But those changes add up, and as they add up, they change the market's structure. Here's the part most commentators miss. The bond market doesn't need a single massive sell-off to move. It only needs the marginal buyer to change. Markets are set at the margin. The price isn't determined by the biggest holder. It's determined by the next trade, the next buyer, the next auction, the next portfolio decision. When the marginal buyer becomes less eager, yields rise even if total holdings remain large. That's why the "who is buying now" question is more important than who holds the most. In the old model, global savings flowed into U.S. assets because the U.S. offered liquidity, stability, and a deep market. That was the exorbitant privilege people talk about, the ability to borrow in your own currency at relatively low cost because the world wants your assets. But privileges only last as long as the world chooses to grant them. If global capital decides to diversify, even partially, that privilege weakens. Borrowing costs rise, funding becomes more competitive. The government has to offer better yields to attract buyers, and that is how geopolitics reaches into your life. Because long-term yields influence mortgage rates, auto loans, corporate borrowing, and even the discount rate used to value the entire stock market. Now layer in energy. For decades, global energy trade helped support the dollar's role, not because of a single agreement or one rigid rule, but because energy markets were heavily dollar-denominated. That meant countries needed dollars for trade, and holding U.S. assets was convenient. But energy trade is evolving. More bilateral arrangements are appearing. Currency swaps are expanding. Some transactions are being settled in local currencies, not always the dollar. This doesn't mean the dollar disappears. Reserve currencies don't die quickly. They erode slowly. They lose exclusivity before they lose dominance. Even a small erosion matters because global systems operate at scale. A shift of a few percentage points in reserve allocations is not a footnote, it's a huge movement of capital. And when capital moves, yields respond. The same story is unfolding in trade. The world is not simply deglobalizing, it is reorganizing. Supply chains are being redesigned around political alliances. Technology is being fenced off. Critical industries are being treated like national security assets. This creates cost pressures. Redundancy costs money. Restrictions reduce competition. Factories moved for political reasons are not always as efficient as factories moved for economic reasons. Over time, those costs can show up as higher baseline inflation. And if inflation becomes structurally higher, interest rates become structurally higher. That is why this matters so much. It's not about one headline. It's about a new baseline for the cost of living and the cost of borrowing. There's also a more subtle effect: trust. The global financial system runs on trust. Trust that contracts will be honored. Trust that reserves won't be frozen. Trust that payment systems will remain accessible. Trust that sanctions won't suddenly reshape what safe assets mean. When trust is questioned, the value of neutrality increases. Neutral assets become more attractive. Diversification becomes more urgent. Shorter duration becomes safer. Harder assets, those not tied to one legal system, become more appealing. This doesn't require panic. It only requires prudence. And prudence, when adopted by large institutions, becomes market movement. A central bank that slightly increases gold reserves. A sovereign fund that slightly reduces long-duration treasuries. A trade agreement that includes non-dollar settlement options. A technology restriction that forces supply chain duplication. Each of these is small alone. Together, they represent a structural shift. Now, here's the trap that forms when this shift meets fiscal reality. If the government runs persistent deficits, it must issue persistent supply. In a world of abundant demand, that's manageable. In a world where demand is cautious and diversified, the government must pay up. Pay up means higher yields. Higher yields mean higher interest expense. Higher interest expense widens the deficit. Wider deficits require more issuance. More issuance pushes yields higher again. That is the dynamic market sphere, not a single crash, but a feedback loop. It's a debt spiral risk, not because the U.S. runs out of money in the simplistic sense, but because the price of financing becomes a growing burden that crowds out other spending and forces increasingly difficult policy choices. And here's where people get confused. Central banks can influence this, but they cannot fully control it without trade-offs. Yes, they can buy bonds. Yes, they can provide liquidity. Yes, they can stabilize markets during stress. But doing that at scale can increase inflation risk, weaken the currency, and reduce confidence. So policymakers face a balancing act. Stabilize yields too aggressively, and you risk inflation and currency weakness. Tighten too aggressively, and you risk recession and financial stress. In a stable, cooperative world, that balancing act is difficult but manageable. In a competitive world where capital flows are shifting, it becomes far harder. This is why long-term rates can start behaving differently than people expect. The public hears about short-term policy moves and assumes everything will follow. But long-term rates are a referendum on the future. If the market believes deficits will persist, inflation risks will remain, and global demand will be more selective, it prices that in, regardless of what anyone says in a press conference. That's how geopolitics becomes personal. And if you've felt something off in the last few years, if you've noticed that borrowing costs stay high even when some indicators cool down, that's the market telling you it expects a different world ahead than the one we lived in before. A world where money is not cheap by default. A world where security costs more than efficiency. A world where borrowing has to compete for capital again. In the next chapter, we bring this down to street level, what this environment means for households, businesses, and investors, and how to think clearly without getting sucked into panic narratives or false certainty. It's easy to talk about bond yields, central banks, and geopolitics as if they exist in a different universe from everyday life. But the effects of those forces eventually show up in the places people notice most: monthly payments, job markets, housing prices, and the cost of basic goods. The connection is not complicated once you see it. When borrowing becomes more expensive, everything built on borrowing begins to slow down. And modern economies are built on borrowing. Governments borrow to fund spending, companies borrow to expand, and households borrow to buy homes and cars. That doesn't mean borrowing stops. It means decisions become more cautious. A company that once financed expansion at extremely low interest rates now has to think twice. A developer planning a new housing project recalculates costs and delays construction. A family considering a home purchase looks at the monthly payment and decides to wait. Each decision seems small, but multiplied across millions of people, those decisions shape the economy. Housing is often the first place this becomes visible. Housing markets are highly sensitive to interest rates because most buyers rely on financing. When rates rise, affordability declines even if home prices remain unchanged. That reduces demand, which eventually affects construction, renovation, and the industries connected to them. This doesn't always mean a dramatic crash. Sometimes it means stagnation. Prices stop rising, transactions slow, and the market enters a long adjustment period rather than a sudden collapse. That kind of slow grind is less dramatic but just as important. Businesses feel the same pressure. During periods of very low rates, many companies took advantage of cheap credit. Some used it productively, to invest in factories, technology, or research. Others used it to buy back shares or finance acquisitions. Eventually, that debt has to be refinanced. If interest rates are higher when refinancing occurs, interest expenses increase. For strong companies, this is manageable. For weaker ones, it can be a serious challenge. This is why periods of higher rates often lead to a rise in bankruptcies, not immediately, but gradually, as debt rolls over. Employment can be affected as well. When companies face higher financing costs and slower demand, they often reduce hiring or cut expenses. That doesn't always produce mass layoffs, but it can slow wage growth and make job markets less dynamic. For households, the most visible effects are often in everyday expenses. Higher borrowing costs for businesses can lead to higher prices. Higher interest on credit cards or auto loans reduces disposable income. Insurance premiums and taxes may rise as local governments and companies adjust to their own higher costs. This is how macroeconomic shifts filter into daily life, not through a single shock, but through a steady increase in financial pressure. At the same time, it's important to keep perspective. Economic systems are adaptive. People adjust behavior, businesses innovate, and policymakers respond. Periods of higher rates are not unprecedented. In fact, historically, interest rates were often higher than what we saw in the 2010s. What made the last decade unusual was how low rates remained for so long. That period shaped expectations. Many investors and homeowners came to see low borrowing costs as normal, even permanent. When conditions changed, the adjustment felt more dramatic than it might have in another era. Understanding this helps separate reality from exaggeration. Financial commentary often swings between extremes. Either everything is fine or everything is collapsing. The truth is usually in between. Yes, the environment has changed. Borrowing is more expensive and global financial relationships are evolving. But economies are resilient and systems rarely break in a single moment. They evolve, sometimes painfully, but they adapt.